Welcome back to EBM N5. In this video, I want to look at a question from the question paper of November 2024. So we are going to look at question 3 on that question paper. So the question reads, I start with the financial statement below and answer the question. So you're given an income statement of Apple Private Limited for the year ended 28th February 2022. So you need just to go through the income statement given. So we go down and try to see, and then also we are given a balance sheet of Apple Private Limited as a 20th February 2022, which you need just to browse through and see the components of the income statement and the balance sheet. So I believe that we have got the first question, which is how well is the business compensating the owner? And we are given a hint of return on assets and analyze whether the business is a good investment. So I remember when we are checking whether the business is a good investment using return on investment, we are going to compare return on investment with the prevailing uh, interest on fixed deposit or interest on alternative investment. Remember, interest on alternative investment is represented by interest on fixed deposit. So we compare that rate with the return on assets. So return on assets has to be greater than the return on alternative investment to indicate that this is a good investment, as it is reaping better returns than alternative investment. So basically, that's what we have. So, but we are going to first calculate the return on assets. So obviously, we need the formula to calculate a return on assets. So we are going to say our 3.1 is a return on assets, whereby we are going to use the formula net profit after tax. So this is our net profit after tax as our numerator. And then our denominator is total assets. And then we multiply by 100 over 1. So basically, that's the formula that we're going to use. So we're going to try to check first the net profit after tax according to the information given. So if you go up, you see that our net profit after tax, we are given it in the income statement, whereby it's indicated here as our net profit after tax, 50,426. So it's going to be our numerator. And obviously, we're going to over total assets, and we try to see what figure for total assets do we have. Obviously, find that figure in the balance sheet. So we go down in the balance sheet to see that our balance sheet is saying total assets is equals to 813,600. 813,600. So we come here. And then obviously, we now multiply by 100 over 1. So try to use our calculators and calculate that. We see that our figure that we are going to get as a percentage becomes 6.1978%. And obviously, we need to round it off to 2 decimal places, whereby we put a 9 there. If you check just behind our 9, we have got our 7. But according to the instructions that we have in the question, we can round it off to 1 decimal place, whereby we have our 1 year, which can obviously is going to be changed by 9 to 2. So it becomes a 6.2%. So basically, this is what we have on that calculation. So this becomes our return on assets. So return on assets is 6.2%. So, having got our return on assets, I will refer back to the question and see the requirements of the question. We're going to see that the question is saying, um, yeah, um, how well is the business compensating the owner? So we need to see if it's a good investment. So it's saying analyze whether the business is a good investment. So we need to see if it's a good investment. So we should be able to interpret our return on assets. Remember, a return on assets shows the percentage of how profitable a company's assets are operating at revenue. So basically, that's a return on assets. So to see if it's a good investment, we have to compare with the interest on fixed deposit, which is going to represent the interest on alternative investment. So we are saying we are not given the interest of alternative investment according to our question. So obviously we use the prevailing interest on fixed deposit in South Africa recently. So you would see that the interest on fixed deposit, which is as per February 2025, it's an average of 7.4%. So we are making a comparison of 6.2%, and then we are saying return on average investment is equal to 7.41%. So this is the prevailing return on average investment, which is the return on fixed deposit in South Africa. So you see that the return that we have for this business is less than the return on alternative uh, investment. So we are saying this is a return on average investment, which is uh, return on return on alternative investment. Which is 7.41%. The return on assets is less than the return on alternative investment. So it means it's not a good investment. So basically, we are saying we are now responding to a question which is saying analyze whether the business is a good investment. So we are going to say no, it's not a good investment. No is our answer, and then we motivate by saying uh, the owner receives a less return on his investment as compared to alternative investment. So our 7.41% is the interest on fixed deposit that is of South Africa as per February 2025. So this is the interpretation that we have to make for a return on assets. You have to compare it with the return on alternative investment. And if it's lesser than a return on alternative investment, it's not a good investment. But if it's more than, it's a good investment. So this is what we have on this part. And then moving on to the second question, it now says, was it worthwhile to take the risk? Yield, you are given the acid test ratio. So we need also to calculate the acid test ratio to see if it was worthwhile to take the risk. So acid test ratio also, we need to come up with the formula first. So the asset test ratio, the formula says current assets minus stock over current liabilities. Current assets minus stock over current liabilities. So basically, if you check, we're going to check the figure for our current assets, total for current assets. Get it in the balance sheet, and we have got our current assets here. You see that the total that we have is 700, 271,200. So this is the figure that we have as our current assets. So we come here, we see 271,200. Then we subtract our stock. So we refer back to the balance sheet and check the figure of stock is the inventory. So inventory is stock. So we have got 124,300. 124,300. So we subtract 124,300. So obviously this is going to be our numerator. And then we check for denominator. We have got to check for the total for current liabilities. We go down to see what we have in terms of current liabilities. We have current liabilities here, of which we have got 180,800 as our liabilities here. 180,800 is going to be our denominator. So with that, we can now be able to calculate so that we find the correct figure. So if you divide there, you are going to get your answer is you're going to get your answer is 0.8125. And obviously this is a ratio. It has to be S to 1. Remember, the asset test ratio, we should present it in the form that we are saying current assets minus stock. The answer that we get, we say is to current liabilities. And then obviously we are going to divide by current liabilities both sides. And obviously this side will remain as 1. So this is exactly what we've done. So here we are calculating this side. When we said current assets with the stock over current liabilities, we're calculating this side. So it's S to 1. So with that now, we can try to round it off. We try to see what do we get there. You see that the final answer that you are supposed to get to 1 decimal place here is we've got 8, we've got 1 just behind, and we obviously it's not going to change our 8, and it becomes 0.8 S to 1. So this is your asset test ratio, 0.8 S to 1. So remember, we go back to the question. The question says, was it worth it to take the risk? So we need to interpret again, is it a good ratio? Is it a good ratio, 0.8 S to 1? So remember, ratios are easy to interpret when we are given a ratio of another business, so we can just easily be able to compare the two. When we are given the ratio of the previous year, and try to check the trend, is it improved or worsened? So in this case, we are only having one ratio. So we need to check the standard. What is the standard in terms of the asset test ratio? So remember, the asset test ratio, it should be at least 1 S to 1. We are saying a good asset test ratio is at least 1 S to 1. So if you check this one, it's less than 1 S to 1 because 0.8 is less than 1. So basically we are saying this one is less than. So it's not a good ratio. So basically we are saying we are going to indicate that our asset test ratio, according to our question, we refer back to our question, was it worthwhile to take the risk? Then we can just say it was not. Wait a while. Take the risk. Why? Because our asset test ratio is below the standard. So now remember, uh, the ratio of 1:1 is acceptable because it means that the business has enough quick assets. Quick assets, we are saying enough liquid assets, assets that can be easily converted into cash. So we are saying the business has enough liquid assets to cover the current liabilities in an emergency. So whenever there's an emergency, how quickly can we pay that emergency? So how quickly can we turn our assets into cash? So in this case, we are seeing that the possibility of us turning our assets into cash is very low. So in that case, we are saying it's not a good ratio. So that's our interpretation when we have such a ratio. So we are saying if the ratio is below 1:1, we have to collect debtors accounts or stop granting credit for a certain period to allow money to flow into your business, which might be too late, causing you to lose business. So that's why we are saying it's not good when it's below 1:1. So that's what we have in terms of the response of was it worth to take the risk. Then we go to 3.3 saying, does the business have enough cash to pay its debts? 50% of sales are on credit. Let's take note 50% are on credit. So in brackets, heat, debtors turnover rate and average collection period. So we have to calculate these two ratios: debtors turnover rate and average collection period. So we go there and calculate. We've got 3.3, whereby we can start with our debtors turnover rate. Debtors turnover rate. So we need the formula first to calculate debtors turnover rate, where we are going to say credit sales. Credit sales over debtors. Credit sales over debtors as the debtors turnover rate. So we need to check credit sales. Remember, we are given that 50% of sales are on credit. So that's how we going to get our credit sales. So 50% of total sales, we are going to get our credit sales. So we check the figure for sales that we have, which is 987,000. So we multiply 987,000 times 50%, then we get our credit sales. So our numerator is going to be equal to 987,000 times 50%. And this is going to be our numerator. And then for our denominator, remember, is debtors. We check the figure for debtors that we have. Debtors, we have debtors here, 96,050. 96,050 is going to be our data. So we come here, we have 96,050. So that's our figures that we have. So we need to calculate it. If you calculate it, you're going to say, if you say 987,000 times 50%, obviously, to get your figure for credit sales is going to be 493,500. And this becomes your numerator, and or we divide by 96,050. So if you calculate it and round it off to two decimal places, your answer is going to be 5.14, 5.14 times. So your answer should be left in 10. So this is the data turnover rate. So obviously we need to interpret again this ratio. Uh, so let's take note our data turnover rate should be between the range 4 to 6. 4 to 6 for us to regard it as a good ratio. So you'd see that this one is within that range of 4 to 6, which is a good ratio. Then we've got another ratio that we need to calculate there, which is the average collection period. So obviously, we also need to come up with the formula for the average collection period. For the average collection period, the formula that we have is going to be 365 divided by data turnover rate. So in other words, we are saying this is going to be your denominator. So with that, we can now be able to calculate the average collection period. So we check the figure that we have for data turnover rate. We remember we calculated data turnover rate here, data turnover rate, and we got 5.14. So this is going to be our denominator. So we are going to say it's equal to 365 over 5.14. And we calculate it, we get the figure that we are going to get as our final answer. It's going to be 71.01167. And obviously, these are we should be able to convert them to days. Remember, these are 365 days. The numerator that we have is representing 365 days. So it means our final answer is in days. So we should round it off to the nearest one number, which is going to be 71 days. So we should be able also to interpret this ratio whereby 71 days. But remember, the credit term, the average credit term that is given is 30 days, 30 to 60 days. So we see that this one is above 60 days, which is 71 days, which makes the ratio bad. It's a bad position. So that's how we can interpret that one. So see that this is the last question that we have. We move on to the next question from this one. And we've got the last question that we want to look at. Oh, the next question that we have is 3.4, and it reads calculate the current ratio. So likewise, we have to try with the formula of the current ratio. So current ratio, remember the formula that we use is current assets over current liabilities, and obviously it's over current liabilities over current liabilities. So this is the simple ratio that we should use. So with current assets, we refer back as remember we have that those figures in our balance sheet. Current assets, the total is 471,200. And then we divide by current liabilities, which is current liabilities, we've got 180,800. As to our current liabilities is 180,800, and then we divide by 180,800. And obviously, we further divide this, we see that the final answer on this side is going to be 1. And you say 180,800 into 271,200, we're going to get 1.5. Round it off to one decimal place, 1.5. So basically, we are saying current ratio Credit ratio is 1.5 S to 1. So this is our ratio. So we should be able also to interpret this one. Remember, for it to be a good ratio, it should be at least 1.5 S to 1. And of which our ratio is 1.5 S to 1, which makes it a good ratio. So that is what we have on that part. We'll move on to the next question, which is now 3.5, saying outline the steps of a successful delegation process to Mr. Gunda. You see that our question has got 14 marks, very important. What are the steps for a successful delegation process? So remember, to delegation is the process of distributing and entrusting work to another person. And obviously the person that is being entrusted or having a work being distributed to him or her should be a subordinate. So it involves a manager aiming to efficiently distribute work. It can be distribution of decision making or distribution of responsibilities to subordinate workers in an organization or business. So that is the description that we have in terms of delegation. So we need to now to come up with a process. What are the steps that are involved when we are engaging in the delegation process? So the steps that we have in there, whereby the first step we have got define the objective, whereby the delegate needs to understand exactly what is expected from them. Then we have got second one, select the correct employee for the task. So we should give the correct employee, not to give someone maybe who doesn't know the responsibility being given. So the delegate needs to have capacity to perform the task, provide sufficient authority, time, and resources. So obviously, for the delegated task to be a success, the person who is work delegated to him or her should be given the authority to execute whatever is given. So that is the essence of this point. And then establish checkpoint for control. Obviously, control measures along the way has to be taken into consideration as they are going to make sure that everything that is going to be done is not going to be out of the lane, but obviously will be something that is within the framework of what is required. So we go to set time to discuss progress. So obviously we have to set time, assist the delegates, but allow them to do the task in themselves. So obviously this is necessary. Lastly, you do not delegate the entire task. So very important. You do not have to delegate the entire task, but you should give components of the whole task. Keep the more difficult component of the task yourself. So you don't have to give technical areas and delegate technical areas, which is core of your position as a superior, because obviously the person you are delegating to is not experienced up to that level. So very important. So this becomes the last point, which is the last step. So basically, this is what we have, guys, for the question paper of November 2024. And this was the question 3. Thank you for listening, and hopefully the video was helpful. And let's take note, more typical examination questions will be uploaded on this channel. So let's stay tuned. Let's subscribe. Let's share the video to all our colleagues who are doing EBM. We'll meet again in the next video.